Uh, your thoughts on first a brief word on the market itself, which is sulking a little bit, but that is only after 1,000-point pullback from the lows. I mean, it's not much, just 50, 60 odd points lower. And what, to your mind, will be the dominating driver? Will it be global markets? Is it possible that, if global volatility returns, things here will not go for a toss once again, and we chart our own course, or you think it'll move in tandem?
Well, I think let me answer this in two parts. So if you look at the geopolitical tensions, definitely has been a cause of concern, and that's basically where the center of volatility is, and probably that will continue till the new equilibrium reaches between Russia and Ukraine. This volatility is expected to continue, and therefore, for probably in the shorter term, it will be more like a consolidation thing, is a more like a range-bound approach. Having said that, if you look at historically, last 40 years, this is not the first time. There are 11 events in last 40 years where we have seen such issues, whether it is a Libya crisis, whether you look at Middle East crisis, whether you look at Iraq war, and many more such events. And if you look at S&P 500, normally it takes about 20 trading days to come back to where it was. And the average fall was about 7%. If you look at Sensex in those 40 years, the average fall is roughly about 10 to 12%. So if you look at Sensex this time as well, it has already declined to that, if you look at Nifty 15,800 kind of a levels, and that was a decline we have seen even in markets. So the bounce was, if you ask me, from the historic trend perspective, the bounce was expected and it has already come through. So probably, hopefully, the worst is over. Does it mean we'll see upside tomorrow? May not be. As I said, the consolidation will be there. Volatility will continue, but it is going to be more like a range-bound movement. I do not see a significant downside more than 7 to 8% from current levels. So net, every decline or this range-bound thing can be more like a bottom-up opportunity. And as I said during the opening of 2022, that this year belongs to stock picking. This year belongs to bottom-up approach. Volatility would be there throughout the year.
Well, Rajesh, hi, good afternoon. I just wanted your thoughts on what's happening with metals. Are you participating in this run? Because it's, we had a big run about 6 months back, then a sharp correction, and now we are in the second leg of this rally.
Yeah, I think as you already summarized, that in last 6 months, we have seen kind of two types of cycles, up and down, then up again. So those are more like, in my view, those are more trading things. Those are not fundamentally long-term predictable kind of movements. More than demand, currently it is driven by more of a supply shock, whether it is a logistic problem, whether it is a COVID problem in China, or current problem of sanctions on Russia, oil, and so on and so forth. Very, very unpredictable. It can go up tomorrow by 10%, or it may open 10% down next day. So as a portfolio manager, we have decided that we will not invest into commodities because there is no competence to predict such behavior, which is more supply driven rather than demand driven. So we are skipping the by and large the entire commodities. But there are many companies which actually are beneficiaries of such commodity upcycles, and there are many specialized companies which are not as volatile as commodity prices. Their business models are more resilient. Like, for example, I don't know if you remember, 1.5 to 2 years back, we were discussing one company in our portfolio, RHI Magnesia. The previous name was Orient Refractories. But there are only two companies in world in refractories, Vesuvius and RHI Magnesia. And the Indian company earlier was known as Orient Refractories. And they are the biggest beneficiary of upcycle in steel industry, not steel commodity price, but upcycle in steel industry. So likewise, there are companies which one can do more like a bottom up, and one can play through the, ride in the good commodity cycle. These companies are debt free with a strong return on net worth and return on capital employed, and it fits our investment criteria. So we have been investing into, that company since last 1.5 to 2 years. I'm not recommending at current levels. Please put a disclaimer. But what I'm trying to say is that there are opportunities which one can pick and choose kind of a thesis.
Let's just put the name up which Rajesh is talking about. It's RHIM. It's at about 598, right, Rajesh?
Correct.
Okay, we'll try and pull that up. 63% this year. I hope you own a lot in your fund, Rajesh.
I think what is more important is, you make money out of such names without taking the risk of commodity prices. And that's all I was trying to drive home. That you don't need to take extraordinary risk. You don't need to predict what will happen next day to crude oil and dollar and pound and steel prices and coal prices. And still you can make a reasonable wealth with a 2 to 3 year holding period.
Any other names you like this? Still available at
say for example in engineering space, people have been talking about hydrogen. You were referring to one of the company which has been also going up 3 times in last 3-4 years. But
Linde India, yeah.
Yeah. So if you look at the engineering space, there is a company which we have bought in about last 4-5 months back, Cummins India. Globally, if you look at the Cummins, which has been forefront of technology, and if you look at the parent company, Cummins Global, they have invested across the technologies. Now, if you are bullish on India real estate cycle, if you are bullish on India infrastructure cycle, if you are bullish on India capex cycle, if we are talking about a $5 billion investment in data centers, there is no way you can live without the DigiSat. But the fear is, what if tomorrow hydrogen comes and DigiSats get replaced? The Cummins Global probably is biggest beneficiary of it because they are the early mover into hydrogen and related technologies. Surely that will flow to even the Cummins India if it happens. And you are getting at a reasonable valuation. You don't need to pay 90 times and 100 times and 200 times. You are getting at a valuation of below 30 times price to earning multiple, a global multinational company with a 50 to 60 to 70% market share across the various horsepower DigiSats and at the forefront of technology. So, you need to catch the opportunity where there is at times some confusion, some debate, doubt that will it survive or not survive, will it participate in growth or not. And at such times, you need to seize that opportunity, and then you can make probably double your money in 3 to 5 years.
That's interesting. Last time when we spoke to you, or maybe not last time, maybe some time back, you had shared your views on some of the auto ancillaries. Are you holding any of them right now in your portfolio? Do you like any of them?
You are absolutely right. And if you remember, we have shared the few names which we are holding, and we continue to like them. One of them is Sundaram Fasteners, which is the biggest beneficiary of global recovery as well as India commercial vehicle recovery, which is likely to already started from last quarter. Second name which we hold in our portfolio is Minda Industries, which is again doing exceptionally well. They are beneficiary of changes in two-wheeler industry, whether it is electric vehicle or whether it is the old IC-based engine. And of course, they are biggest beneficiary of change in what I would say consumer behavior and the change in government regulations. So whether it is an alloy wheel plant, they are the largest beneficiary of alloy wheels. Whether you are talking about airbags, Minda Industries largest player in airbags, and many more such things. So if you look at the content per vehicle of company like Minda Industry, it is going up every year by 10, 15, 20, 30%. So one is you get the organic growth of automobile industry. Second is you get the increase in content per vehicle. That's a very, very big scope for companies like Minda Industry. And third is they do not get impacted negatively because of change in this trend to EV. In fact, they get positively impacted because of change in EV kind of regulations. So we continue to hold that names, and there are 1 or 2 more names which we hold. So we continue to like very selective auto ancillary. And I keep using the word, this year is a bottom up. So if you look at sector in general, I don't think that's the right way to look at it, because there are companies which may close down in 5 years. You may not see their names because they are not beneficiary of EV. They will get disrupted very badly. And there are names which will probably scale up the revenue 2 to 3 times over next 4 to 5 years. So you need to be at the right side of auto ancillary industry.